For decades, the California dream was built on a foundation of sunshine, innovation, and, perhaps most importantly, ever-appreciating real estate. It was a bet that seemed impossible to lose. But in 2025, the rules of the game have changed dramatically. We're not here to scream collapse from the rooftops. We're here to provide clarity. What we're seeing across the Golden State isn't an apocalyptic crash. It's a long overdue correction, a fundamental recalibration of one of the world's most complex housing markets. The triggers are no secret. Mortgage rates have doubled, shattering affordability for the average family. Insurance premiums have skyrocketed, adding hundreds to already strained monthly budgets. And the pandemic-era migration surge? It's decisively cooled. But here's the critical insight everyone is missing. This isn't just about higher costs. This is about a historic shift in psychology. The unwavering belief that a California home is a one-way ticket to wealth is finally being challenged. Buyers are no longer desperate. They're patient. Sellers are no longer in control. They're negotiating. And that change in sentiment is creating a wave of opportunity and risk that will define the next decade. This is the story of 10 cities where this shift is hitting hardest. We're moving beyond the headlines to analyze the data, the demographics, and the underlying economics. If you're looking to buy, sell, or simply understand the new reality, you need to see this. This is your data-driven guide to the Great California Correction. Let's begin. Kicking off our countdown at number 10 is Ventura. Nestled between the glamour of Santa Barbara and the sprawl of Los Angeles, this scenic coastal city long offered the perfect compromise. Stunning Pacific views without the stratospheric price tags of its wealthy neighbors. During the pandemic frenzy, Ventura was anything but a compromise. Home prices exploded, soaring a jaw-dropping 47% from $620,000 to over $910,000. It was a market running white-hot, with bidding wars and properties selling in days. But in 2025, the music has stopped. The data reveals a market undergoing a profound structural reset, not just a temporary cool-down. Let's look at the numbers. The most telling metric? Inventory. The number of homes on the market here has exploded by a staggering 280% year-over-year. What was once a trickle of options for buyers is now a flood. This massive surge in supply has completely shifted the power dynamic from sellers to buyers. The result? Homes that once sold in a matter of weeks now languish on the market for an average of over 70 days. That for sale sign is becoming a permanent fixture on many lawns. And this new reality is directly impacting prices. The median home price has already slipped from its peak to around $845,000. That means the average homeowner has seen over $65,000 of their hard-earned equity evaporate. And it's not just the median. Even Ventura's crown jewels, luxury waterfront condos, are seeing aggressive price cuts of $100,000 or more, and they're still sitting unsold. So, what's driving Ventura's great deceleration? It's a perfect storm of three key factors. First and foremost, affordability collapse. With mortgage rates where they are, the monthly payment on a median-priced home now tops $5,400. Stack that against the area's median household income of just $93,000, and the math simply doesn't work for local families anymore. The dream has been priced out. Second, the insurance crisis. Recent wildfires have made this area a high-risk zone in the eyes of insurers. Premiums have skyrocketed into the thousands of dollars annually, adding a significant, recurring cost that scares off would-be buyers and strains current homeowners. Third, the investor pullback. The short-term rental market isn't the safety net it once was. With Airbnb bookings down, investors are left holding vacant units and mounting bills. This is forcing many to sell, further adding to that overwhelming inventory and creating a negative feedback loop. Ventura's correction is a clear case study of a market that overheated and is now normalizing. Its fate is also tied to its larger neighbor. As Los Angeles continues its own slide, a city we'll discuss later, the pressure on Ventura is only expected to intensify. It's a challenging new chapter, but for patient buyers, it may also be the beginning of a long-awaited opportunity. Coming in at number 9 is a city that represents a very different, but equally important, part of the California story, Fresno. Long hailed as the state's last bastion of affordability, This Central Valley hub became a magnet for families priced out of Los Angeles and the Bay Area. The numbers from the boom years are staggering. Between 2019 and 2022, home prices here leaped an incredible 60%, from $280,000 to $450,000. This wasn't just appreciation, it was a gold rush. Developers scrambled to meet the demand, paving over fields to build entire subdivisions almost overnight. But in 2025, the music has stopped. The promise of affordable growth has collided with economic reality, and Fresno is facing a reckoning. The data tells a clear story of a market tipping into oversupply. Active listings have ballooned by a shocking 340% in just 2 years. All those new homes that were built to catch the wave are now competing fiercely for a shrinking pool of buyers. This glut of inventory is putting intense downward pressure on prices. The median home price has already slipped back below $410,000. And perhaps most tellingly, properties that once sparked bidding wars now sit stagnant for 3 months or more, a clear sign that buyer urgency has been replaced by extreme caution. So why is Fresno's correction particularly vulnerable to a deeper slide? The reasons are structural. First, the overbuild. Fresno's Achilles heel is its own success. The rapid development during the boom has led to a hangover of supply. Many new builds remain unfinished or unsold, creating pockets of empty streets and for sale signs that serve as a constant reminder of receding demand. Second, economic headwinds. The Central Valley's job market is one of the state's weakest. With median household incomes lagging significantly behind the state average, the doubling of mortgage rates didn't just strain budgets, it shattered them. Affordability is built on income, and that foundation here is fragile. Third, the scourge of scarcity. Fresno faces a chronic and worsening water scarcity crisis. For potential buyers, this isn't just an environmental issue. It's a fundamental question of long-term value and livability. It's a powerful deterrent. Fourth, the insurance squeeze. Like much of the state, rising insurance premiums are adding a heavy additional burden on top of already challenging mortgage payments, pushing total ownership costs higher. This isn't just a small cool down. For Fresno, this is the early stage of a major market slide. The dominoes are lined up. If unemployment ticks up even slightly, we could see a painful repeat of the foreclosure crises that have hit this region in the past. Investors are already feeling the squeeze, with flat rents failing to cover rising costs. Fresno's story is a cautionary tale about what happens when breakneck growth meets economic and environmental limits. At number 8, we arrive in Sacramento. This city was the undisputed poster child of California's pandemic-era migration. As remote work took hold, a wave of Bay Area tech workers, armed with equity and soaring San Francisco salaries, descended upon the capital, seeing it as the ultimate affordable Bay Area. The numbers were dizzying. Home prices skyrocketed 60%, from $365,000 in 2019 to a peak of $585,000 in 2022. Sellers were cashing in, and buyers felt they had finally found a way into the California market. But by 2025, the script has completely flipped. The tide has turned, and it's turning fast. The data reveals a market flooding with options and starving for demand. Inventory hasn't just increased. It has surged by 300%. There is now over 7 months of supply on the market, a clear indicator of a decisive shift to a buyer's market. When supply exceeds 6 months, prices fall. It's a fundamental rule of real estate. And fall they have. The median home price has already dropped by nearly $60,000. The homes that once attracted 10-plus offers now sit ignored for 90 days or more. The euphoria has been replaced by for sale signs that are fading in the sun. So, what triggered Sacramento's sharp reversal? First, the migration slowdown. The remote work relocation trend has significantly decelerated. Companies are calling people back to offices, and the initial wave of migrants has already come through. The primary engine of demand has downshifted. Second, the affordability wall. Like everywhere else, doubled mortgage rates have made monthly payments untenable for many locals. The very affordability that drew outsiders evaporated for Sacramento's own residents. Third, the insurance crisis. Many suburbs in the Sacramento Valley are now classified as high wildfire risk zones. Insurance premiums have become prohibitively expensive, adding hundreds of dollars to monthly carrying costs and destroying the math of ownership for many. Fourth, the investor pullback. This is critical. The rental market, which investors banked on, is now oversupplied. Rents are flatlining, but mortgage and maintenance costs are not. This is panicking investors, who are now quietly unloading properties, sometimes at a loss, which further floods the market and drives prices down. The ripple effect is hitting Sacramento's entire economy. The coffee shops, restaurants, and service industries that thrived on new arrivals are reporting steep slowdowns. The boomtown glow has faded, replaced by the harsh reality of a market that expanded too quickly and is now contracting. Sacramento isn't just slowing down. It's watching its pandemic-era gains vanish in a painful and structural reset. At number 7, we find a city facing a perfect storm of economic and social challenges, Oakland. Long considered San Francisco's more accessible and culturally vibrant cousin, Oakland offered a path to Bay Area homeownership without the stratospheric price tags. From 2015 to 2022, its housing market exploded by nearly 70%, with the median price peaking at $900,000. Investors piled in, betting on relentless spillover demand from its wealthy neighbor across the bay. But in 2025, that bet is failing. Oakland's decline is sharp, complex, and layered with crises that go far beyond rising interest rates. Let's break down the data. The numbers are stark. Inventory has spiked over 260%. The median home price has tumbled below $820,000, wiping out tens of thousands of dollars in equity. But the most telling metric? Days on market have nearly tripled since the peak in 2021. The bidding wars that defined the past decade have been replaced by something new: relentless price cuts, seller desperation, and a growing inventory of stale listings. However, to only focus on the housing data is to miss the real story. Oakland's unraveling is driven by a confluence of deeper, structural issues. First, the urban exodus. The city is grappling with a pronounced exodus of residents. Concerns over rising crime rates, highly visible homelessness, and a hollowed-out downtown, where office vacancies soar and entire commercial blocks sit empty, are driving families and young professionals to the suburbs or out of state entirely. The demand base is eroding. Second, the economic spillover effect. Oakland's economy is deeply tied to San Francisco's. With tech layoffs and the persistence of remote work gutting San Francisco's core, the ripple effects are being felt acutely here. The small businesses, cafes, and cultural spaces that gave Oakland its edge are now closing. Tax revenues are shrinking, creating a vicious cycle that strains city services further. Third, the investor flight. The investors who once saw Oakland as the next big thing are now retreating. The calculus has changed. Stagnant rents can no longer cover soaring mortgage payments, property taxes, and maintenance costs. Many are cutting their losses and selling, adding more fuel to the inventory fire. This isn't just a market correction. It's a crisis of confidence. Oakland's identity as the Brooklyn of the West is being tested like never before. The city that represented opportunity and cultural authenticity is now becoming a cautionary tale about how urban vitality can quickly fade when economic, social, and housing market pressures collide. At number 6, we arrive at a city that knows the pain of a housing crash better than any other: Stockton, California. This was ground zero during the 2008 foreclosure crisis. And in 2025, the chilling echoes of that past are becoming impossible to ignore. During the pandemic boom, hope surged anew. Priced out of the Bay Area, buyers flocked here, believing Stockton was California's last true affordability stronghold. Home prices soared 58%, from $325,000 to $515,000. It was a dramatic, optimism-fueled rally. But today, that optimism has shattered. The data reveals a market buckling under familiar pressures, and the parallels to 2008 are unnerving. The most alarming metric? Inventory has exploded by over 350%. But the number that truly sends a shiver down the spine is the quiet, steady climb in foreclosure filings. For Stockton, this is a haunting sequel. The median home price has already slipped below $470,000. Families who bought at the peak are watching their hard-earned equity vanish, and many are already underwater on their mortgages. The city's one defining advantage, affordability, has completely crumbled. Why is Stockton so vulnerable to a deep and painful correction? The reasons are deeply entrenched. First, the affordability illusion. With mortgage rates doubled, the math no longer works. The median household income here is just $78,000. A monthly mortgage payment on a median-priced home is now catastrophically unaffordable for most residents. The demand pool has evaporated. Second, the economic foundation. Stockton's job market is one of the weakest in the state. It lacks the diverse, high-wage industries needed to support homeownership at these levels. When economic headwinds blow, Stockton feels them first and hardest. Third, the city service strain. Chronic issues like crime, underfunded schools, and strained utilities are driving residents away. As people leave, tax revenues shrink, creating a vicious cycle that makes it even harder to fund the services needed to attract and retain families. Fourth, the speculator hangover. Investors who poured in during the boom are now rushing for the exits. They're finding rental demand soft and are liquidating properties at a loss, further flooding the market and accelerating the price decline. The warning signs are all there. Vacant homes multiplying in older neighborhoods, unfinished speculative builds, and landlords slashing rents just to fill units. The city that was supposed to represent resilience is slipping back toward the same trap. The scars of 2008 never fully healed, and this new crisis threatens to cut even deeper. Breaking into the top 5 at number 5 is a city that embodies the California dream, San Diego. America's so-called finest city, with its perfect climate and booming biotech sector, long seemed immune to the harsh rules of real estate economics. Between 2019 and 2022, that belief was reinforced as home prices exploded 55%, from $600,000 to over $930,000. Buyers, investors, and families were convinced that coastal living here was a bulletproof investment. But in 2025, the wave has broken. Even endless sunshine can't shield a market from a brutal affordability reckoning. The data shows a city experiencing a significant and accelerating correction. The most immediate signal? A massive influx of supply. Inventory has surged by 280%, flooding the market with options for a rapidly dwindling pool of qualified buyers. This oversupply is forcing a painful reality check on prices. The median home price has already slipped below $880,000. And the discounts are not just happening in the far-flung suburbs. Luxury coastal estates in La Jolla and Del Mar are seeing price reductions of $150,000 to $200,000. Even condos in hip, centrally located neighborhoods like North Park and Mission Valley are recording 15% declines and sitting unsold for months. So, what's driving the unraveling of one of Southern California's most desirable markets? It's a collapse of affordability. First, the mortgage payment shock. With current interest rates, a standard mortgage on a median-priced home now exceeds $6,200 a month. Even for San Diego's dual-income professional households, doctors, engineers, scientists, that is a staggering burden. Once you add in property taxes and maintenance, the math becomes unsustainable for many. Second, the insurance crisis. San Diego County is another epicenter of California's wildfire and climate risk. Home insurance premiums have skyrocketed, adding hundreds more to monthly carrying costs and effectively pushing ownership further out of reach for countless families. Third, the investor squeeze. The investors and second home buyers who helped fuel the boom are now pulling back. Those who counted on robust rental income are finding the market softening. The short-term rental gold rush has also cooled, leaving some with vacant units and mounting costs. The cracks are spreading beyond real estate. Local restaurants and boutique shops that thrived on the spending of affluent newcomers are reporting slower foot traffic. The era of effortless, double-digit appreciation is conclusively over. San Diego isn't facing a sudden, chaotic crash like some inland cities. Instead, it's undergoing a steady, painful, and accelerating correction. For many homeowners who bought at the peak, the dream of coastal security is being replaced by the anxiety of a prolonged decline and the fear of negative equity. And at number 4, we find a market that was supposed to be untouchable, Malibu. For decades, this wasn't just a housing market. It was a realm for celebrities, CEOs, and international elites. The rules of economics didn't seem to apply here. Staggering price tags weren't a deterrent. They were the very point. At its peak, the median home price here hit an astonishing $3.9 million. But in 2025, even Malibu is being pulled back to earth by gravity, and it's a hard landing. The data reveals a stunning reversal of fortune. The median price has already slipped nearly 15%, wiping millions of dollars in paper wealth off the coastline. But the most telling metric isn't the price drop, it's the stagnation. Listings that once sparked all-cash bidding wars within days now languish on the market for over 200 days. Sellers are being forced to chop $500,000 to $1 million off their asking prices just to generate a flicker of interest, and many are still failing to sell. Why is a market this exclusive facing such a dramatic slowdown? The reasons are as unique as Malibu itself. First, the carrying cost catastrophe. The biggest shock for owners isn't the mortgage, it's the insurance. Relentless wildfires and mudslides have made this one of the riskiest zip codes in America to insure. Annual premiums have skyrocketed, now routinely exceeding $25,000 and often topping $40,000 for homes in high-risk zones. When you add six-figure property tax bills and immense maintenance costs, the price of holding onto paradise has become prohibitive, even for the ultra-wealthy. Second, the climate risk reckoning. Malibu is on the front lines of climate change. What was once a scenic risk is now a calculated financial liability. This is actively spooking the pool of international investors and second-home buyers who once saw this as a safe haven. The glamour is now weighed against genuine peril. Third, the shift from need to want. This is the most crucial factor. Buyers in Malibu don't need to live here. It's a discretionary, luxury purchase. In a stable economy, that discretionary demand is strong. But when uncertainty rises and wealth feels less secure, these are the first purchases that get postponed or canceled entirely. Even A-list celebrities are now choosing to rent rather than shoulder the immense burden and risk of ownership. For the first time in decades, Malibu's sellers are chasing the market. They are not setting the terms, desperate buyers are. It's a profound psychological shift that proves no market, not even one cloaked in sun and glamour, is truly immune to the cold, hard rules of economics and risk. At number 3, we arrive at a global icon of luxury and wealth, Beverly Hills. This has long been the crown jewel of California real estate, a symbol of success where price tags seem to be a mere formality for the world's elite. In 2022, the median home price here soared to a breathtaking $4.2 million. But by 2025, the gloss is showing cracks. The median has already slipped below $3.8 million, a correction that wipes hundreds of thousands of dollars from the balance sheets of even the wealthiest homeowners. But the real story isn't in the median. It's in the ultra-luxury segment, the market's engine. Estates listed above $10 million are flooding the market, but the international buyers simply aren't there. Price cuts of $1 million to $3 million have become a quiet, painful norm. Some properties now sit unsold for nearly a year, a previously unimaginable scenario in this zip code. The factors behind this high-stakes slowdown are unique to this rarefied air. First, the retreat of foreign capital. The lifeblood of this market has always been international money, from China, the Middle East, and Europe. Geopolitical tensions, economic uncertainty abroad, and stronger capital controls have reduced this flow to a mere trickle. The pool of buyers has shrunk dramatically. Second, the cost of owning a trophy. It's not just the purchase price. Soaring insurance premiums, rising property taxes, and new mansion taxes or transfer taxes on high-value sales are adding millions in carrying costs over time. The trophy is becoming exponentially more expensive to keep in the case. Third, domestic flight. Wealthy American buyers are increasingly looking at alternatives. States like Florida, Texas, and Tennessee offer not just lower home prices, but significantly lower tax bills and perceived lower climate risks. For a growing number, the Beverly Hills address is no longer worth the premium. The anxiety is palpable behind the gated drives. Sellers who never imagined their property could stagnate are now facing a new reality. Their home is a luxury, and in an uncertain economy, demand for the absolute finest things can evaporate overnight. Even here, confidence is proving to be the most valuable commodity, and it's in short supply. At number 2, we are confronting the sheer enormity of the correction. This is Los Angeles. The sprawling city of dreams, ambition, and reinvention is now the epicenter of a housing reset of historic proportions. From 2019 to 2022, the LA market went supernova. Home prices exploded from $650,000 to nearly $1 million, a surge fueled by pandemic-era migration, investor mania, and seemingly limitless demand. But in 2025, the cracks are not just visible, they are chasms. The data is staggering. Inventory has surged over 300%. To put that in human terms, there are now over 40,000 active listings clogging the market across LA County. This isn't a shift, it's a deluge of supply that has completely drowned out demand. The result? The median home price has already slipped by $70,000. But that's just the average. In luxury enclaves like the Hollywood Hills and Brentwood, sellers are slashing prices by $200,000 to $500,000 per property. The homes that once sparked 20 offer bidding wars now sit ignored, a stark monument to a bygone era. But LA's problems run far deeper than mortgage rates. This is a perfect storm of structural urban crises. First, the urban unraveling. The city is grappling with a homelessness crisis at historic levels. Crime concerns, whether perceived or real, are pushing families to seek safety and sanity in the suburbs or out of state entirely. The very quality of life that justified the premium is deteriorating. Second, the commercial collapse. Downtown LA is experiencing a commercial real estate meltdown. Office towers sit half-empty as remote work endures, hollowing out the business districts that supported local economies. This crisis is spilling over into the residential market, eroding confidence and property values. Third, the rental domino effect. The rental market, once LA's saving grace, is now buckling. Thousands of new luxury apartment units have hit the market simultaneously, causing vacancies to rise and rents to stagnate. This has panicked investors, who are now quietly unloading properties, sometimes at a loss, which further floods the for-sale market and accelerates the price decline. Fourth, the climate tax. Wildfire insurance premiums in hillside neighborhoods now routinely top $7,000 a year. When combined with soul-crushing traffic, shrinking job growth in its signature entertainment and tech industries, the math of living in LA simply no longer works for many. The Dream Factory is being forced to face its harsh economic limits. The City of Angels is witnessing a divine correction, and the reset is only just beginning. And now, we arrive at the epicenter of the crash. The number one city where home prices are set to drop the hardest, San Francisco. This was the undisputed crown jewel of California real estate, a city where tech billionaires, venture capital, and global money collided to create a market that defied gravity. In 2022, it reached its zenith. The median home price hit an astonishing $1.65 million. It was the peak of what many now see as the ultimate housing bubble. But by 2025, that bubble has burst with a violence that has reverberated across the entire state. The numbers are not just bad, they are catastrophic for a market of this caliber. Inventory has surged nearly 320%. The streets of once impenetrable neighborhoods are now lined with thousands of unsold homes. The median price has already plunged below $1.5 million, vaporizing over $150,000 in equity for the average homeowner in just a few short years. But the true horror story is unfolding in the luxury condo towers that reshaped the downtown skyline. Units there have plunged 20% or more. Entire buildings stand half-vacant, dark monuments to evaporated demand. And perhaps the most chilling sign of all, foreclosures, once a unicorn-like rarity here, are quietly ticking upward again. It's a haunting echo of 2008 playing out on the most expensive streets in America. However, the housing data is merely a symptom. The disease is the collapse of San Francisco's very ecosystem. The tech exodus and the remote work revolution, the city's engine has stalled. Tech layoffs have gutted the high-earning workforce. But more permanently, the widespread adoption of remote work has dismantled the core reason to live here. Why pay a premium for a 700-square-foot condo when you never have to go to the office? The urban doom loop. This is the vicious cycle crippling the city. Empty offices mean failing downtown businesses. Failing businesses mean plummeting tax revenues. Plummeting tax revenues mean cuts to essential services, which exacerbates the very problems, like crime, homelessness, and open-air drug markets, that are driving more residents and businesses to leave. The city is eating itself. The crisis of confidence. Families are leaving in droves, citing an unlivable cost of living and deteriorating quality of life. Even the most bulletproof enclaves, Pacific Heights, No Valley, the Marina, are watching their invincibility shatter as for sale signs multiply. The myth of endless tech-driven demand is gone. What remains is a city bleeding population, hollowed out by a tax base in collapse, and watching its housing market slide with no clear bottom in sight. San Francisco isn't just experiencing a correction, it's undergoing a fundamental revaluation. Its fall from grace may not just be the deepest in California, but the sharpest in the entire nation. So, what does the story of these 10 cities tell us? This is no longer a prediction or a warning. It is the new reality. The California dream, built for decades on the promise of endless appreciation and limitless growth, is facing a structural reset. The forces driving this are not fleeting. They are deep, interconnected, and powerful. The affordability collapse, driven by interest rates that have doubled monthly payments. The insurance crisis, adding a devastating annual tax for simply owning a home in a state of climate peril. The Great Migration, as residents and capital seek refuge in states with lower costs and lower risks. The economic shift, with remote work unraveling the urban core and tech volatility shaking the state's financial foundation. This is not a uniform crash. It is a spectrum of pain. From the luxury freeze of Malibu and Beverly Hills, where discretionary spending has halted, to the affability implosion of Stockton and Fresno, where the math of basic ownership no longer functions, to the urban unraveling of San Francisco and Oakland, where social and economic crises are accelerating the decline. A market that soared 70% or more in just a few years doesn't gently cool off. It corrects. It crashes. It resets. And in that reset, there will be both casualties and opportunities. For sellers, it's a lesson in humility. For buyers, it's a lesson in patience. For everyone, it's a lesson in economic gravity. The era of easy money is over. The golden glow has dimmed. The road ahead is one of calculation, not speculation. The Great California Correction is here.